therefore it is very important to make sure that it is not only about alpha, but it is more about low drawdown, less decline in case the market goes down, and very importantly, the consistency of the performance. Correct. So that's what basically what we offer to our investors. So that's as far as the philosophy goes. And as far as the stock selection goes, it is basically, we have a very unique framework called 3M investment approach: market size, market share, and margin of safety. So we buy the best of the companies with the best of the market share, with the best of the management, with best of the governance, and with best of the financials. But that is not enough, of course, to create alpha. What is very, very important is, on that we have put up a concept of business cycles. And cycles are getting compressed, am I right? So it is very, very important to monitor cycles of the companies in which you are investing into. And then on top of it, what we look at is basically when to get out of it. So one is the stock selection, and second is, of course, the discipline exit strategy. So our investment process or investment style, if you ask me, is defined as, causality. So quality and agility. Quality to make sure that we invest into the right companies, something very, very important, and agility to make sure that we don't get stuck to it, because business cycles changes rapidly, and we therefore take the opportunities, we look at the valuation, we look at the growth of the companies, and based on the growth outlook, based on the valuation, based on the competitive peer group, then we exit from these companies depending upon how we look at the opportunities.
Rajesh, it's been 14 years that since inception for your fund and for your PMS, and you've been giving a CAGR of 18.2%, which basically means that if someone would have invested 1 crore, it would have been more than 10 crores or close to 11 crores in that period. When you look at investments, does all your stocks look at a long-term perspective, or you break it down between some stocks for long-term, some for mid-term, and some short-term bets?
Well, I think when we look at investment, there is nothing called short-term, medium-term, long-term. I think everything, when we bought, everything is for long-term. When I say long-term, 3 to 5 years time horizon. So that's how basically we buy the business, any company what we buy in our portfolio. But it so happens that, as I'm saying, the cycles are getting shorter, and that results into the wilder swings into the market valuations, that greed and fear. And the wilder swings in the earnings because of the increased volatility in the business cycles gives you opportunities on both the sides. Let me give you one example. Like 2020, I remember, before lockdown, we sold cyclicals and we bought pharma. We made almost, pharma is a 14-15% of our portfolio. And we thought pharma companies will give us, 15, 18, 20% compounding, so about 60-70% returns in 3.5 years. But to our surprise, pharma gave us 65% returns just in 4 to 5 months. Now, when all the returns got upfront ended in just 5 months, the prudent decision is to get out of it. So we sold pharma companies and we bought back the cyclicals which we sold in month of March. So by October, if you remember, the unlockdown started, phase 1, and we sold cyclicals and we sold the pharma and we bought back cyclicals. So what I'm trying to say is that we need to monitor the valuations, we need to monitor the growth cycles. Like, for example, 1.5 years back in March 2022, when Russia and Ukraine became a topic of the town and Fed was increasing interest rate, our IT sector weightages were 14%. We reduced to almost 7%. Yeah. And after that, of course, IT index came down by 20, 30, 35%. So because the valuations were full. And during last 2 months, as the valuations have compressed, the time correction has happened, and as we believe that probably US will enter into, probably again the growth environment over the next 12, 24 months, we have started, again adding to our IT sector weightage. And as I speak with you today, probably we are moved from underweight to neutral, not yet overweight. So that's how we look at it. We look at business cycles. We don't have a time period in mind when we will sell. We sell when we believe, the assumptions are going to change, or when the valuations have turned expensive, or there is a better risk-reward opportunity. That's how we do the investment, sectoral and stock changes.
That's the agility you're talking about when you spoke about, investing in quality and agility and being agile in terms of investing. But what has been the kind of churn that you have seen? Have you seen a frequent churn because of the kind of volatility which has now come into the market in the last 2 to 3 years?
Yeah, I think as the cycles become more volatile, you have to change your sectors. So let me put it another way: 50 to 55% of my portfolio might be 3, 5, 7. Few companies are even 10 years we are holding, in our portfolio. So it depends upon how your sector performs. Say, for example, if you buy one large FMCG company and the stock goes up every year, say 12, 15, 16%, you don't need to do anything, you just hold on, correct? But there are companies which goes up, say 200% in a year, correct? For example, IT companies. During 2020 and 2022, in 2.5 years, many IT companies went up 150%, which was, it never used to be in the previous avatar, right? In that case, you need to do the profit booking, you need to, again, reevaluate how it should look like. That's how we look at, so we are not bothered about the outcome, that churn or dynamic rebalancing, whatever you call it. What is more important is that how we look at that company from today's perspective. So we don't follow kind of a model. Everything is to be reviewed, how company positioning is from now. That's what matters the most.
What about market cap selection? Because, we saw money moving into market cap, large cap companies 2 years back, and in the last year or 18 months, we have seen small caps being very active, very volatile. They've been outperforming the large caps by a big margin. How do you decide on when to stay on with the large cap, despite the fact that they must be giving you 10 to 12% return every year, as you said, but maybe switch over a portfolio to small caps, which is now going to perform?
Good question. So, our multi-cap plan, which is a AAA India IOP, India Opportunity, PMS, and also AAA India Equity, AIF, basically it is a multi-cap. So we have roughly about 50 to 55% is roughly about large cap, and about 50% is a combination of mid cap and small cap. And we don't try to time it within it, because that's the most complicated thing. Rather, we do that bottom up and try to see, where do we see the highest upside with the lower risk kind of thing. And that's how the portfolio gets constructed. So that's a broader mix for us, roughly 55% kind of thing large cap, and about 40-45% is a combination of mid cap and small cap. And we don't try to time that, okay, now mid caps are expensive or small cap. I know people have been saying mid and small cap are expensive from last 6 months, but it continued to deliver. So I think then what is more important then is look at what kind of companies you have bought. Am I right? And if you think the valuations are absurd, as I said, then our agility comes into play. Anyway, we exit that company if it is turning extremely expensive, and we look for the better opportunity. When it comes to our AAA budding beast, that's primarily mid and small cap, plan, and that basically, it is almost, I would say, 95% is mid and small cap. As such, no large cap, unless and until company's market cap increases because the share price increases, and it moves large cap. It's a separate issue. Otherwise, it's entirely, within the mid and small cap.
Because I was looking at the returns for two of your funds. One is the budding beast, and the other one is the India Opportunity. Now that has given a 1 year return of 16.4%, which is the India Opportunity, and the budding beast has given a 40.7%. So as a fund manager, do you get tempted to go for returns or stay with the chosen companies? Because if you had shifted your portfolio allocations in small cap, the returns would have been much higher, like your budding beast has given you.
Yeah, I think investment management for the fund manager, that's something most important. Keep control on your emotions, am I right? And don't get swayed by the emotions that, oh, this can happen or that can happen. Important is to have the right process in place, and important to have the risk management in place. If the investor who is looking for higher return and higher risk, he can opt for our budding beast, which is a mid and small cap offering, correct? And an investor, who has selected AAA IOP, he is not looking for that kind of high return, because his risk appetite is also not to that extent, am I right? And we all agree that mid and small cap space, as such, is definitely more volatile and requires a different patience compared to a person who is coming into the multi-cap portfolio. So both are completely separate. The risk-reward mandates are completely different, and that's what we adhere to. And we don't change within that, because that will be the most. I think there are many guys who try to do that within multi-cap, swing to large to mid to small. But I think what is very, very important is that what is the mandate given by investor to you? What is risk return expectations? And you should have finally, fulfill, your promise of delivering his risk return mandate. And that's something very, very critical.
And how do you, do you churn more often as soon as you get returns within the small and mid cap? What kind of when we look at this class of equity, which is small and mid cap, one of the biggest challenge everyone has faced is with respect to liquidity, exits. Now there's so much of flows which are coming into small cap and mid cap, not only for you as a PMS but also for mutual funds. Do you see easy exits and easy liquidity available for any investor to get in and get out easily from this class of investors? Because a couple of years back, if there was a big rally in small cap and there is a small sudden fall, people would have got stuck.
Absolutely. So that's where something very important, the risk management comes into play. So, if you look at the market cap definition, 1 to 100 is called large cap, and then 100 to 250 is called mid cap, and everything after 250 is called small cap. So there are 5,000 listed companies. So from 258 to 5,000, every company is considered as small cap. But that's not how we look at it internally. When we look at companies, we look at the profit-wise buckets. So in India, to give you perspective, there are about 600 companies in India, which is roughly 100 crores plus reported net profit. That's basically is our universe. If you look at 50 crores plus, another 200 companies. That becomes total 800 companies. And we select from that. So if you look at our portfolio quality of our names of our AAA budding beast, which is a mid and small cap, we don't buy actually any small company by revenue. We don't buy any small company by profit size. We don't buy any company small by market share. All my companies are large in terms of revenue, profit size. They all are market leaders. But the market cap, they are not 1 to 100, and therefore they get classified as a mid cap and small cap. Let me give one more quantified data, So our budding beast average weighted market cap is roughly about 30,000 crores. 30,000 crores. And therefore, it by default, it is a lesser risk compared to the generic, small cap as a bucket, am I right? And therefore, if you look at the beta of our portfolio, is actually less than BSE 500 index. So average weighted market cap is very high, profit size is very high. Most of our portfolio companies, they are either debt-free or they will leverage less than 1 time. Most of portfolio companies would be 18-20% ROE, and they all are growing by 20% plus over next 1 or 2 years. So that's how we construct the portfolio, and therefore the risk from the liquidity perspective or even otherwise is significantly lesser for our AAA budding beast compared to the normal generic mid and small cap definition of the market.
Rajesh, hang on a bit. We're going to a small break. When we come back, we'll discuss some of the sectoral themes that Rajesh has been investing into. Stay tuned to Portfolio Manager. Welcome back to NDTV Profit. You're watching the Portfolio Manager, and with me is Rajesh Kothari, founder and MD of Alpha Accurate. Rajesh, I'm looking at some of the things that you've invested. When I look at the India Opportunity Fund, you are looking at banking as the biggest exposure, 26.7% of your exposure. But when I look at the budding beast, you have banking much below. It's, I think, number 5 in your list, and your biggest exposure is to the consumer sector. So give me a sense of how do you see the consumer sector? What is the team working for you there? And in the banking space, what is it actually working for you?
So I think both plans are completely different. So I'm talking
about the investing theme and sectoral themes point of view.
Oh yes, correct. So the few important sectors where we are significantly, I would say, bullish on. The one is the capital goods. This is the one sector which we have been bullish from last almost 3 years. And of course the journey has been very rewarding. We are holding the best of the companies within capital goods, particularly the companies which are product is the main what I would say the revenue stream for these companies. So they have very strong mode, R&D, innovation, and there is a huge growth driven by the new growth drivers. Be it a data center, be it a smart grid, be it a automation, be it a robotics, kind of thing. So that's the one sector on which we are very bullish. Second sector on which we are bullish is the consumer sector. Within consumer sector, there are further sub-segments within it. So one is, for example, FMCG. And that's a space where we are very, very selectively positive because the raw material environment is now turning positive and the rural economy is likely to recover. But we have been broadly underweight this segment from last almost 2.5, 3 years. Then there is another sub-segment which is called a discretionary. This includes retail. This is the largest holding for us as a within consumer. The discretionary is the largest holding, and we own companies which are number 1 into the retail within this space. And the third segment comes is the building material. So we have been very bullish on real estate as a theme, and therefore we are holding the proxy companies like top companies in wire and cable, the top 5 companies of the pipe industry, or the top companies of the plywood sectors, and so on and so forth. So these are the various sub-segments within consumer segment on which we have been bullish, and that's how we are positioned for, be it a AAA IOP or be it a AAA budding beast.
How do you look at banking then? Means from a banking point of view, will you look at private banks, public banks, NBFCs? Within public, you have the new found favorites of the market, which is the IRIDA or IRFC or others, which is railway led or renewable led. Will you be looking at those kind of? What is your view on that segment actually?
So banking and finance is, of course, is the one sector which we like from now here on, and we, I think we've been adding weight here in last, I would say, few months. But importantly, again here, there are various sub-segments within banking and finance. So one is private sector banks, second is public sector banks, third is the NBFC, and fourth is others. Correct? Others means exchanges, asset management companies, the wealth management firms, the brokers, and so on and so forth. So we again try to select the companies. We try to see what will be the impact of the interest rate cycle on the various buckets and take a position accordingly. So currently, we have been positive on private sector banks as well as PSU banks. NBFC, we believe, will be the beneficiary as the interest rate gets reduced. From last, therefore, 4 months or so, we have been adding more to NBFC side compared to the banking side. And others is one thing which we like. So we are holding, few companies which are primarily exchanges, in our portfolio, which has been again very, very rewarding. So this is how we have, constructed our stocks within banking and finance sector.
2 sectors: auto ancillaries, and IT. Auto has been something which has been performing well. IT is something which has been underweight because of the kind of headwinds they are facing. How do you look at auto as a whole and auto ancillary as a whole? Do you see any pain in some of the segments, or is it the runway which is there, which is quite good for them?
I think auto and auto ancillary is again one sector which we have been very bullish from since last 3 years, and again that has been working fantastically well for us. Within auto, again there are sub-segments: commercial vehicle, passenger vehicle, two-wheelers, and auto ancillaries. So we have been very bullish on commercial vehicle space from last 2.5 years, but now we are exiting that CV space and we are becoming more bullish on two-wheeler from since last few months. So that's basically within OEM, we are shifted from CV to two-wheeler. Auto ancillary is a space which we like because here there are many companies which are going to be beneficiary of electrification of the vehicles. The content per vehicle going to increase significantly for a few of these companies within this sector, and that gives a massive opportunity of almost kind of a 2x, 3x, 4x kind of an opportunity for many auto ancillary companies. So that's basically broader theme for auto and auto ancillaries.
What about
IT sector?
What about passenger vehicles? You didn't mention
passenger
much.
vehicle, we are, currently we are holding on a very, very selective basis. I mean, there's only one OE perspective. But incrementally, if you ask me, I think there is a bigger probably upside which is there in auto ancillary compared to the, the OEM side of CV or PV.
And that's primarily limit to companies which have an exposure to electrification of vehicles, basically you're saying.
You are right. So auto ancillary companies are, there are post these new trends of electrification and a lot of new things, there are going to be two parts of auto ancillary. One, companies probably which will not be visible after 10 years. Probably they will die on their own because they are not changing. So auto is no more a auto sector. There is a lot of technology which is coming to the automobile sector. So your R&D, the new product launches needs to be extremely strong. So companies which are focused on R&D, companies which are focused on innovation, they are going to win this game within auto ancillary space. So there are companies who are changing their business model rapidly. They are moving away from just one segment to the multiple segment. So if a company is catering to two-wheeler, now they are moving to two-wheeler plus car industry plus commercial vehicle. And also there are companies which are significantly benefit from the electrification of the vehicle. More and more wiring, more and more, aesthetics within the vehicle, more and more the smart features within the vehicle. So there are companies which are geared to take benefit of this premiumization of the vehicle, inside the vehicle I'm talking about, okay? And those are the companies which are probably going to get exponential benefit because competition is very limited in that space and size of opportunity in terms of the value addition is significantly higher. So for example, one of the auto ancillary company in which we have invested, their current content per vehicle is about say 1,000 rupees kind of thing. And that can increase to almost 4,000 to 5,000 in terms of the size of opportunity, which is a 5x. So that's huge. So there is exponential opportunity for very select companies within this auto ancillary space.
Mm-hmm. Can you also give me a sense of how you look at the software or IT sector, and within IT, are you looking at engineering R&D separately, or product companies separately, and services separately? And if at all, which segment are you bullish on or bearish on?
I think you have absolutely rightly said. So we look at within that IT services, the product companies, ERD players, and of course the normal IT companies. So as I'm saying, we have been underweight on this sector from last almost 18-20 months. And recently from last, I would say 1.5 months or so, we have been adding selectively, to this bucket. And we like within this, the product companies, because there are companies who have invested significantly in last 7, 8, 10 years. And in product business, what happens is that first you have to spend a lot on your R&D, on your software, and so on and so forth. But once you enter into your customer, it becomes extremely sticky business. And therefore, the volatility of your business cycle over a period of time, it actually reduces significantly because it is an annuity business. It is a very, very sticky business, becomes an annuity business. So again, you need to be very, very selective. We own one of the company where we believe that there is a potential to, again, significant, highways there for company to grow in terms of the penetration, be it a, Europe market or be it a US market. And as you enter into new customer, initially there might be few licenses, but over a period of time, you have a significant scope to multiply the number of users. And the model is moving from just a license-based revenue to SaaS-based revenue. Pay as you use more. And that can be also very, very rewarding in terms of both, profitability as well as what I would say from the revenue scale-up perspective. So I think it's a very interesting thing which is happening in the product side. And so you need to be selective, and that's how we are positioned within IT sector.
Final question, I see from your portfolio that commodities has a very low weight and that exposure to cement is there and not any other. Are you underweight metals and other commodities?
Yeah, we basically don't take, most of the time we don't take any exposure to commodities, particularly the global commodities like metals or oil and gas, because we believe that we don't have competence to predict the currency or the tariffs. Global tariffs are very important when you buy any commodity company, or the commodity price itself, because commodity prices are not determined by natural demand and supply. They are determined many more factors which are beyond the economics. So geopolitical things can change your tariff policy. The global currency volatility can significantly change your margins. The anti-dumping duties kind of thing can significantly impact your business, either side, positive or negative. So I think these things are, I don't think is anybody's hands, and therefore, we generally don't invest into commodities or businesses which are kind of a commodity businesses.
Rajesh, it was a pleasure today talking to you. That was Rajesh Kothari of Alpha Accurate discussing his portfolio and funds. Thank you for watching The Portfolio Manager.